what's up? This is Joshua Stanton, your mortgage dude. And today I am doing a video on a simulation of the all-in-one loan. It is super dynamic and it helps people pay off their mortgage quicker and cheaper than normal mortgages. I do a lot of different videos, so please subscribe to my YouTube page to check out those videos, and feel free to get in touch with me if you have any questions. I personally have the all-in-one loan. My wife and I got it quite some time back, and we use it to multiply properties, amongst other things. So if you have questions about what we've done, I'm happy to share. So without further ado, I'm going to share my screen and we're going to get into the simulation that I have built. Now, I took information that I found online about Colorado. I'm using Colorado, but I wanted to find out what the estimated average home value was in Colorado in 2022, as well as the mortgage balance estimated average, and income average, the median income for Colorado. So I built this scenario on those numbers. I'm happy to take a look at other scenarios. If people would like, just get in touch with me. Before we get into too much detail about this, the all-in-one loan is a mortgage product. It is different. This mortgage product was built to help people accelerate the payoff of their mortgage, and it was also built to help people pay less in interest on that mortgage as well. The way it does that is the interest is calculated totally different. This is a simple daily interest calculation versus a normal traditional mortgage that has a schedule that's fixed and it's amortized over a 30-year period of time. That algorithm ensures that the banks make a lot of money, really normally somewhere around 50% or more of your home's value in interest. Whereas with the all-in-one loan, the quicker you pay down your mortgage, the less and less interest that you pay because of this interest schedule that recasts. Every time you put money into the loan, the balance goes down that night at midnight and the interest goes down alongside of it. So it creates a snowball effect for paying off the mortgage. It's really interesting and very detailed, but the goal of it is to help people. The second part of this mortgage that is so different is that it has a built-in home equity line of credit / checking account. So you can push money in and pull money out whenever you want. You don't have to call and ask me or any banker or anything like that. You can push money in to pay off your mortgage quicker and cheaper, pull money out if you find something that you need money for. We do it all the time. You can do it as many times as you want. It's like mortgage freedom. It's a mortgage with a checking account. So let's get into this scenario. So I looked up the average value of a home in Colorado in 2022. It's $575,000. Loan balance around $300,000. I picked an interest rate that was really low for this scenario. Currently, interest rates are a lot higher than this, but let's just say that these people are looking into something else. They have a mortgage, a 30-year fixed mortgage at 3%. We're going to compare that to the all-in-one loan for this scenario, see how it turns out. They've had the mortgage for a couple years. They refinanced, let's say, when interest rates dropped during the pandemic, and they've got a really low interest rate. So let's go on to the next page. I talked to these people about their income, and they had the median income. I was describing that on the last page. It's about $83,000 per household is the average right now in Colorado. That varies state to state, but in Colorado, it's $83,000 is the median income. So put that in monthly. And then the next page is spending page. This is really important. So I always, when I take clients to this page, I want to break down their monthly spending habits, because this mortgage is not for everybody. This mortgage is for people that live within their means, simply put. If you have a 700 credit score plus, if you have pretty good debt to income ratios, which means that you're most likely living within your means, maybe not paycheck to paycheck, and you have a little bit of assets, then this could be for you. So we're going to break down their income. We've got the $6,916 is what they get monthly. And then the traditional mortgage principal and interest comes out of that. And then the homeowner's insurance and taxes come out. And then they've got a bunch of money left over. And this $3,812 is what they spend on the rest of their lifestyle. Let's just say it's their credit card payments, maybe phone bills, their internet, their car payments, fund money, etc. That's how much they spend on average. They have somewhere around $1,383.20 left over per month. This is pretty good. This means that they're not living paycheck to paycheck on average. Some months, maybe they are living paycheck to paycheck. It gets expensive around the holidays, right? But the rest of the year, let's just say that they average somewhere around $3,883 left over. Well, that money with the all-in-one loan is going to go towards paying down principal quicker. Again, if you need it back for whatever, this thing has a built-in checking account. You can borrow money from yourself if you need any particular amount of money back that you have available. You can take it back to pay for a health emergency or whatever, a new car, whatever it is. Okay, so we're going to go ahead and calculate results. And this is fun. So we've got the traditional mortgage over here. If you remember, you saw that I put in this mortgage at 24 months, they've had it, right? As compared to the all-in-one loan. So if these people just lived their lifestyle that we built into this, they didn't do anything different, they just lived their lifestyle, they had the all-in-one loan, chances are they'd pay off their mortgage in somewhere around 13.8 years instead of 28 years. So that's huge. And the reason why they're paying off their mortgage so fast is because that extra money that they're not using on a monthly basis is going into this thing, paying down principal, right? And it's still available for them should they need it. So in my opinion, that's a no-brainer. That's what really sold me on the all-in-one loan initially, but let's break it down even further. So if you look at the breakdown of the numbers in this scenario, you've got the average minimum monthly payment for the all-in-one loan, $868.32 in this scenario. That's interest versus the minimum traditional mortgage payment. It's about $13.20 right? The average principal reduced monthly for the all-in-one loan, you're going to be paying down an average of somewhere around $1,818.18. That's a funny number. I didn't realize that when I worked out this scenario. Versus average principal reduction monthly of $892.86. The reason that this is so different is because with the all-in-one loan, your money goes to principal first. All right, plain and simple. The object of this game is to pay down your mortgage quick. So if you're putting money in, money goes to principal, it's snowballing your payoff. Your payoff is going to be quicker versus a 30-year fixed that is designed for you to be in the mortgage for 30 years and pay the bank a specific large amount of money. Let's go to a pay down table real quick. And I just want to kind of highlight how this works. And I'm just going to go down to 12 months. And then we'll scroll down a little bit more to 24 months. And you can start to see how the all-in-one loan is starting to get paid down a lot quicker than the traditional mortgage. Go to 36 months. And you can see it's really starting to give you more equity quicker, right? Now let's return to summary. I want to look at the graph real quick. Okay, so this graph is cool. This graph is, it basically shows you how the all-in-one loan works versus 30-year fixed loan graph form. And, you know, if you take a look at let's just say it's a few years down the line, you can see, you know, you'd be chugging away at your 30-year fixed loan, not really making too much of a dent in it. You as you can see, after a few years, the traditional mortgage principal balance is somewhere around 236,000. The all-in-one loan balance, significantly less. That's about halfway through. We get down to zero. You paid off your all-in-one loan. You have a zero balance on your mortgage after, was it 14.2 years? Or 13.8, I'm sorry. And, you still have 184,490 or 59.34 to pay off on your traditional mortgage. It's all because of the acceleration of this mortgage and how it works, right? For the remainder of the term with the all-in-one loan, after you pay off the mortgage, you can opt to just keep the loan open, and it's just a home equity line of credit. So anywhere along the way here, you have a zero balance, you're not paying principal or interest or anything, but if you want to borrow money from it, you can absolutely take money out to, build a new deck or whatever you need. It's your equity, it's your money. You do whatever you want from it. You can borrow from yourself. So in essence, you're a little bank. Okay, so I'm going to return here to the results, and let's look at one more thing before I get into some other numbers. I'm going to go to the paydown table. Rates and assumptions is what I wanted to look at. The all-in-one loan is not a fixed rate mortgage, although we do have some products. We've got a 3-year fixed, then adjustable, and a 5-year fixed. The most important, or the most popular, I should say, mortgage term is the 1-month adjustable, and it's because of how it works. Historically, it's cheaper than the 3-year or the 5-year fixed. So the interest rate is built of the margin plus the index. The index moves, it goes up and down. Historically, it's been coming down, but over the past few months, it's definitely gone up with the other interest rates. It moves around. The floor rate is 3.75, and then right now it could go up to 14 if things got carried away in the market, which I really don't think is going to happen, but it could. The average rate that we're using in this scenario is 5.966. That's because with the simulator, we built in the last 25 years of historical data of movement with this mortgage. So if we look at the graph, we see the movement of the 1-year CMT index. That's the index that we use for the all-in-one loan. And you can look up this index online and read about it if you want. But this is just a simple graph of the last 25 years. So you can see it goes up and down depending on what the market's doing. Right now it's going up. It looks like it's about to, plateau. Maybe it'll take a down tick. I'm personally hoping, and I do believe that it is. That's what people have been forecasting. It might ease a little bit, but this is kind of how it works. It goes up and down, never goes above the 30-year fixed by design, but that's kind of what the last 25 years have looked like. So I think it's going to ease down a little bit now, but we'll see what happens. So anyways, we just close out of that. Return to rates. So again, average rate used 5.966 for this scenario because that's what it's done over the last 25 years. We have no idea what it's going to do in the future, but this is about the average rate. So we're comparing this average rate to the 3% with the 30-year fixed loan. And just remember that this is a daily simple interest mortgage versus a fixed amortization 30-year interest mortgage. So let's return to those results. And now I'm going to really get nerdy. So I just worked up some really quick numbers. Here we go. You should see this now. Got the median household income in Colorado, the average mortgage used, and the value. But if you remember, we're paying off the mortgage a lot quicker with the all-in-one loan. 28 years with the 30-year fixed versus 13.8 years with the all-in-one loan in the scenario. So that's a difference of 14.2 years. So after you pay off the mortgage, in 13.8 years, what are you going to do with your free money? You know, that's exciting. You're no longer going to have the biggest debt in most people's lives. So that's a huge deal. So let's get into this a little bit. So let's say the monthly principal and interest payment for the traditional mortgage, that was $1,320, if you remember from the scenario, times 12. That's $15,840 extra dollars that you can be using for other things per year. So we're going to multiply that number by the 14.2 years and see what it comes out to. So 1,320 times 12 times 14.2 equals $224,928. So that's kind of a huge number, even over 14.2 years. That's a lot of money that you can use to do other things in your life, buy other properties, help your kids out with school, whatever you want. It's your money. It's going to be free to you to do whatever you want now that you don't have that pesky mortgage anymore. So let's say you earn 7% on that money, and that's pretty meager. That's like $1,108.80 per year. So that's an extra $15,523.20 gain just, you know, from a very simple investment. But you know, here's another thing. What if you rent that home after you've paid it off? So not only do you have that extra money in your pocket every single month, that $1,320, but let's just say that you rent that property, you're living in a new home, and you rent that place for $2,000 a month. That's $24,000 extra dollars per year times 14.2 years is $340,800 over the course of 14.2 years. So that's huge. That's life-changing money. You know, you can have this, you can do whatever you want with this. I just built this really, really simplistic scenario to show you that your dollars do not need to keep going into the mortgage forever. We need to break out of this trend of having a mortgage forever. There are so many other things that people could do with their money, and real estate is a great way to multiply your money and really set yourself up for a fantastic retirement where you don't have to worry about the stock market and things like that. There's risk in everything. I know that, but I just would rather put more money into real estate than other things. So I hope you enjoyed this scenario. I hope that it made sense to you. The all-in-one loan is pretty complex, but once you get it, it's kind of like a light bulb switch in your head. It goes on and then it's like, oh my God, I can't believe that this is a real thing, but I'm here to tell you it is real and it's really awesome. So get in touch with me if you have any more questions about the all-in-one loan. I'm happy to run scenarios for you and your family. Please subscribe to my YouTube channel. I'm going to keep pumping out videos about the all-in-one loan and other mortgage products. So if you're looking to purchase a home or refinance, you have questions about this or other products, I'm happy to talk to you. Get in touch with me. It's Joshua Stanton, your mortgage dude. I hope you have a great day.